Hey guys, in this video let's compare Newmont Corporation to Barrick and see which one is a better buy. If you guys enjoyed this video, please consider subscribe to my channel and leave a like if you really enjoyed it. Also, you can join my Patreon group to support my channel and you can see my live portfolio in action. Newmont and Barrick Gold is world's #1 and #2 gold producers. Gold producers produce the gold for mining and sell it at a profit based on the gold price. The higher the gold price, the more profitable they are. So which one of these two companies is a better buy? Let's take a look at some of the valuations. If we look at the 5-year chart for both companies, they are almost identical in terms of the gains. Newmont stock price go from low of $15.70 to recent stock price of $66. That is over 320% gain in just 5 years. As for Barrick, the stock price was at low of $6.35 to recent price of $29. That is over 356% gain, just slightly better than Newmont. Market cap for Newmont is around 53 billion and market cap for Barrick is 52 billion. 2019 revenue for both companies is almost identical as well. 9.74 billion for Newmont and 9.74 billion for Barrick. 2019 cash flow from operation is around 2.87 billion for Newmont and 2.83 billion for Barrick. And free cash flow is around 1.4 billion and 1.1 billion. Note that in 2020 Newmont should be generating higher revenue than Barrick due to the merger of Goldcorp in January 2019 that was closed in April 2019. For mining companies, there are two ratios that I like to look at. They are price to sale ratio, which will give you a general view of a company if they are overvalued or not. Second, the price to cash flow ratio. Price to cash flow ratio is more accurate way of looking at the actual money made in the company. It is far more accurate than PE ratio. Price to sale ratio is 5.4 times for Newmont and 5.3 times for Barrick. Price to cash flow ratio is 18.5 times for Newmont and 18.4 times for Barrick. When the price to cash flow ratio is less than 20, it's considered good. So just looking at these ratios, you can tell that these two companies aren't that expensive. Now let's compare their production profile and their asset base. Newmont have gold reserve of 95.7 million ounces and additional 63 million ounces of gold equivalent ounces. That include zinc, lead, copper, and silver. Newmont have significant silver reserve at 652 million ounces of silver and silver resource of 481 million ounces. Barrick's gold reserve is 71 million ounces with significant copper reserve at 13.5 billion pounds. From the reserve point of view, we can see that Newmont has a bigger gold reserve, and if you prefer more silver as a byproduct, then Newmont is better for you. And if you prefer copper as a byproduct, then Barrick might be better for you. Another area investors should consider is jurisdiction risk of their assets. Location of their asset matters in my opinion, at least for me. So when you are valuing a mining company, it is important to put jurisdiction risk into consideration. Now let's look at their reserve breakdown by location. Newmont's reserves are broken down into 4 continents. 37% in North America, 30% in South America, 21% in Australia, and 12% in Africa. Where Barrick's breakdown is 16% in North America, 15% in South America, 22% in Africa, and 49% elsewhere. If we look at these breakdowns, Newmont clearly is in a better jurisdiction than Barrick for their assets. Only 12% are in Africa. Africa is considered less favorable jurisdiction. The best jurisdiction for mining right now is North America and Australia, which Newmont have almost 60% of their reserve are in North America and Australia, where Barrick only have 16% of their assets in North America. However, about 50% of current Barrick's production is from North America. Barrick's 61.5% Nevada joint venture with Newmont accounted for almost all the North America production. Newmont's total gold production for the next 10 years is stable around 6 to 7 million ounces with all-in sustaining costs around 850 to 950 per ounce. Barrick's 10 years production is around 4.6 to 5 million ounces of gold with all-in sustaining costs around $920 to $970 per ounce. Now let's take a look at their balance sheet. They are pretty much identical in this category, with cash on hand of 3.8 billion and debt of 6 billion for Newmont, and cash on hand of 3.7 billion and debts of 5.1 billion for Barrick. Current ratio is slightly better for Barrick at 3.8 times and Newmont is 2.8 times. The calculation for current ratio is current asset divided by current liabilities. Current ratio gives you a better understanding of how many times current assets covers their current liabilities. If the number is below 1, it means the company's liquid asset cannot cover their short-term debts. In this case, both companies will not have any issues to pay down their short-term liabilities. Although both companies have over 5 billion of long-term debt, but in a net debt basis, they only have about 2 billion, which is very healthy for the company of their size. So I wouldn't worry too much about their debts. So overall, their balance sheet is pretty clean and expected to get better with higher gold price. The importance of free cash flow. The most important part of any business is not just generating profit, but ability to generate free cash flow. That's no difference from mining companies. In fact, free cash flow is more relevant for miners because they have huge overhead costs, such as depreciation and capex. So if a mining company can generate free cash flow, that means this sector is very healthy. This is exactly what is happening. Gold producers are producing huge amount of free cash flow. Newmont are able to generate 3.4 billion of free cash flow per year at 1800 gold price. Although Barrick did not give free cash flow projection, but they should expect it to at least produce 1 to 2 billion of free cash flow at 1800 gold price. In conclusion, I think both companies are a great buy in a gold bull market. They are definitely the go-to names if you want less risk and have good leverage to gold price. And I do expect them to increase dividend as their free cash flow increases and become a significant dividend payer in the future if gold price stay above 1800.